Ever wondered what the types of financial reports are in Indonesia and what they entail? Well, this is your lucky day. In the complex world of accounting, there are 4 types of financial reports that businesses in Indonesia are mandatorily required to prepare. These reports are the lifeblood of any organization, providing crucial insight into its financial health and performance. Today, we will delve into these 4 types of financial reports and shed light on their importance. First up, we have the balance sheet or Neraca. The balance sheet is like a financial snapshot, capturing a company's financial position at a specific point in time. It's comprised of 3 main components: assets, liabilities, and equity. Let's break these down. Assets, they're the resources a company owns. Think of them as the economic fuel that powers the business. This could be anything from cash in the bank to inventory to buildings and machinery. Next up, liabilities. These are the company's obligations or what it owes to others. It could be a loan from a bank, money owed to suppliers, or even wages due to employees. Lastly, we have equity, also known as owner's equity or shareholder's equity. This represents the ownership interest in the company. Essentially, it's what's left over when you subtract the company's liabilities from its assets. So imagine a company as a scale, with assets on one side and liabilities plus equity on the other. The goal is to keep this scale balanced, hence the name balance sheet. So in essence, a balance sheet gives you a snapshot of a company's financial position at a specific point in time. Next, we explore the income statement or Laporan laba-rugi. This financial report serves as a performance snapshot, showing how a company has fared over a specific time frame. It's like a scoreboard at a football match. But instead of goals, we've got revenue, expenses, and profit or loss. Let's break it down. Revenue is the income generated from the company's main activities, like selling products or services. Imagine a bakery selling loaves of bread. Each loaf sold contributes to the revenue. Expenses, on the other hand, are the costs incurred to generate this revenue. For our bakery, this could be the cost of flour, yeast, baking equipment, and even the baker's wage. The difference between the revenue and expenses gives us the profit or loss. If our bakery sold a lot of bread and managed its expenses well, it makes a profit. But if the costs outweigh the sales, it suffers a loss. Thus, an income statement provides a summary of a company's financial performance over a certain period. Moving on, we have the cash flow statement or Laporan arus kas. This is the financial report that gives us a detailed account of how a company's cash and cash equivalents have moved in and out of the business during a specific period. Imagine it as a business's cash diary, documenting every penny earned and spent. Now, this cash movement is divided into 3 main categories: operating activities, investing activities, and financing activities. Cash flow from operating activities is the cash generated from the company's core operations. Think of it as the cash earned from selling products or services. Next, we have cash flow from investing activities. This is the cash used or generated from buying or selling assets like property or equipment. It's like if a company sold an unused vehicle, the money received would fall into this category. Lastly, we have cash flow from financing activities, which shows the cash received or paid out for things like loans or owner's investments. If a company took a loan to expand its operations, the cash influx would be recorded here. In a nutshell, a cash flow statement tracks the flow of cash in and out of the business over a period. Finally, we have the Catatan atas Laporan Keuangan, or notes to the financial statements. This component of financial reporting is a treasure trove of information, providing additional context that complements the main financial reports. They're like the secret sauce, the decoder ring that unveils the mysteries within the other reports. The purpose of these notes is to explain and expand upon the data presented in the balance sheet, income statement, and cash flow statement. They delve into the accounting policies the company employs, significant assumptions used when preparing the reports, and other crucial information that may not be immediately evident from the main reports. For instance, if a company has a significant amount of its assets tied up in property, the notes might provide details about the nature of these assets, their valuation, and any related commitments or contingencies. This helps paint a more precise picture of the company's financial health and performance. In essence, these notes act as a bridge, providing the necessary linkages and explanations that allow for a comprehensive understanding of a company's financial position. They are the threads that weave together the other financial statements, making them a cohesive and comprehensive tapestry of information. So, the notes to the financial statements provide the necessary context and details to understand the other financial reports better. So, to recap, we've explored the four principal types of financial reports in Indonesia. The balance sheet, showing a company's financial position at a certain date. The income statement, revealing a company's financial performance over a specific period. The cash flow statement, detailing the company's cash and cash equivalents movement over time. And the notes to financial statements, providing additional information to explain and complement the other three reports. These reports offer invaluable insights into a company's financial health, performance, and cash flow, aiding stakeholders in making informed financial decisions. Remember, understanding these financial reports is key to making informed financial decisions. Until next time, keep learning,